Welcome to the Monthly MOTR Checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. We're going to get started with our video here. There's a theme running around this notion that the stock market is kind of whistling past the graveyard of all this really bearish macro data, and the market's up and seems to be ignoring all this growing, large, stinking heap of macro data. And I just want to make the case that that's not at all the case, and that and that it's not that it's necessarily bearish, but it's not nearly as bullish as it might look if you're just looking at the S&P. So let's hop into this and whistling past the graveyard, not so fast. So for me, having done this for a long time, there's nothing better than when everyone is bearish that the market just kind of keeps going higher, ignoring all the naysayers and everything else. And given the sort of like the high level price action and the sentiment and everything, it seems that that's what's happening right now. It seems like that might be one of those moments right now. But I would say not so fast, because a case can easily be made that the market is actually fully engaged with all of these, the bearish thesis and the bearish macro data. And I'll walk through that in what I think we should be doing about it as investors, as we're trying to navigate this clear disconnect. But the idea is that, it's more neutral than anything, kind of range bound. And until we're trending, frankly, in either direction, but at least trending, this non-trending strategy environment requires non-trending strategies. So you need to be a lot more tactical. Maybe when you're thinking about buying, wait for the market to be oversold as it is presently, or when the market's overbought, maybe put a curb your enthusiasm and maybe put some brakes on your purchases, especially if you're a large money manager. The whole notion of being tactical can sometimes be frustrating, but all it means is when the market's overbought and up in the 43 to 4,400 area on the S&P, just be a little bit less enthusiastic, and when it's oversold, be more of an aggressive buyer. But beyond that as well, because we're not trending, this is not a high risk taking environment. Just keep your position smaller, no leverage, and as I said, buy oversold and sell overbought. And sell overbought includes initiating shorts if you are so inclined and able to do that. So right now, although it doesn't look like it based on what the S&P is doing, and as I just indicated, it's in that 43.75 to 44.75 resistance area, given the impression that the market's overbought. But in truth, the average stock is actually quite oversold. So there's yet another disconnect for you to have to digest. But I'll show you what I mean and what we should be doing about it. But overall, the disconnect is more neutral than being necessarily bearish. So the idea is that we will absolutely get another bull market. All I'm saying is that this is just not that moment. We are far from what we would consider to be a bull market. And I'll show you an example of what a bull market looks like in my work, and then you can see how far away we are from that actually being the case. So let's do that real quick before we actually jump into today's charts. Let's look at like an example of what the market looks like as it's transitioning from bear market to bull market in our modeling process. Now I have this data with survivorship bias free data all the way back to the 1950s. And so I've studied every bear market bottom since then. And if this rally off the October bottom turns out to not be the beginning of a new bull market, that will be the first time since that will be the first time since the 1960s that this modeling process falsely identified a bull market. So as many of you know, I've been bullish since shortly after the October bottom, and all based on the things I'm about to show you. And so if it turns out that this ends up rolling over into, if we roll over from here, it's not going to be a cyclical bear market. It'll probably be a crisis bear market along the lines of a global financial crisis kind of thing. But if I'm not saying we're going to do that, but if we do, this will be the first time since the 1960s that we actually accumulated all the evidence to say that the lows are in and that the long-term picture should eventually evolve more bullishly. This will be the first time that didn't happen despite the evidence. So this is the market leading into the global financial crisis. So I could have picked any of the bottoms since the 1960s, but I thought I'd show this one just because it was pretty violent, and many of us kind of lived through it. So here's an example. But I want to point out to begin with is that in the early the fourth quarter of 2007, while the market itself was up against its all-time highs, or at least the highs of that cyclical bull market that came off the '02 bottom. As that was taking place, you want to look down here and see that the biggest bucket of trend was actually 39% of the market was in a clear downtrend. So while the S&P itself was up against its highs, almost 40% of the market actually looked like this. So there was a massive disconnect. And again, these disconnects do happen, particularly at major turning points in the market, but they don't last for long. And the two markets, the average stock and the S&P, they tend to finally move together. It's not always bearish. Sometimes, like in the 1994 bear market, we had a massive bear market beneath the surface. This modeling process did a great job of identifying it. But in the S&P, in that window of time, never went down more than 10%. But eventually, these two things came back together again, and off we went into what ended up being a massive bubble into the 2000 peak. But what I want to identify here is how the internals of the market begin to deteriorate before the market actually shows that deterioration on the surface. And this is a great example of that. So into the first quarter of 2008, of course, we began to see material deterioration where the vast majority of stocks went into a downtrend. 36% uptrend, 25% uptrend. So at this point in time, this was still just a cyclical bear market, crisis bear market. So when you get something like 90% of the market in a downtrend, but nonetheless, the point is that you can see that most stocks are doing what the S&P is doing. So they're in keeping with each other. They're confirming each other. And what I'm saying is that we have nothing like that today. But nonetheless, as this bear market continued to progress, and then as the third and fourth quarter came around, this bear market spilled over into a crisis bear market. And by the time we were at the bottom, we only had 2% of the market was in an uptrend. 8% was in a consolidating uptrend, meaning that only 10% was in an uptrend, meaning 90% was in a downtrend. So again, this modeling process did a fantastic job of modeling that. It guided us through that window of time very well in my prior job. And coming off the bottom, what you notice is that on this rally, there was a significant plunge in the percentage of stocks in a clear downtrend, where a significant percentage of them went into a base, this is what we look for. This is the long-term quarterly chart. This is, by the way, these trends are measured on the long-term quarterly chart. So as you know, I do this in 3 time frames: monthly, quarterly, and weekly. Quarterly, monthly, and weekly. And the reason I do that is because it's fractal in nature. And the quarterly can't possibly improve until the weekly improves first, which then spills over into the monthly, and then finally the quarterly. So we don't act necessarily on the quarterly because it's too slow, but what we're looking for is a surge in the weekly that forces the monthly to recover. And going back to 1960, when we've had that combination, and it's forced the monthly to recover so much that the quarterly starts to recover as well and demonstrate high momentum, not necessarily trend yet, but high momentum, 75% of the market displaying high momentum on the quarterly chart. That always, since the 1960s, has spilled over into a bull market. And you can see that unfolding here. As the market came off that bottom, 55%, 44% of the market was in a long-term base. You already had signal to be bullish from the monthly charts, which were already trending, but that monthly momentum eventually pulled this long-term quarterly fundamentally driven trend into an uptrend. And you can see that the biggest bucket on the quarterly chart was clear uptrend. So 46, 32, 33, 43. This is what a bull market looks like. And this is what it looks like when you transition from bear market to bull market. Okay, so where are we today? So when you look at the models that I present, as I've indicated, I measure this in long-term, medium-term, and short-term. And the reason I do that really just goes back to Dow theory and Charles Dow in the late 1800s. And he talked about the 3 time frames of trend and how the short-term is driven by emotions, the intermediate term is driven by some sort of combination of emotions and fundamentals, but the long-term is driven by fundamentals. So I refer to this as the 3 Fs that drive the 3 time frames. So the long-term trend is driven by fundamentals. That's it. If the fundamentals are good, that underlying is going to go up, whether it's the market, if it's commodities, Bitcoin, whatever it is. If the fundamentals are positive, that quarterly chart will trend positively. Along the way, you get flows back and forth that are driven by literally position size changes at large fund managers, slowdowns in the economy that don't really derail the long-term trend. Whatever it is, it's just flows that can kind of come back and forth and can really at times derail that intermediate term trend without damaging the long-term trend. But nonetheless, that medium-term trend is driven by flows. And then finally, the final F is feelings. So we've got fundamentals, flows, and feelings. And of course, that short-term trend is driven almost entirely by sentiment and feelings and how people feel about the fundamentals that they're observing. So keeping that in mind, this is what we've seen, obviously, since the COVID lows. Keeping the color match together here, where we have the fundamentals, black, green, and red. You know, these long-term multi-year trends don't take place unless there's strong fundamentals. And at the same time, they don't take place without strong flows and strong sentiment. And the people like to get all bearish when everybody's bullish, but the truth is, most trends in the middle of the trend, in the meat of the trend, are coincident with strong sentiment. People are bullish. It's usually in the beginning of the trend when people are bearish. But once people accept what's going on, people become bullish, and that's what you want. You want that because that drives bull markets. And the idea is you get all three of these segments of trend working together. Periodically, from time to time, you'll get these kind of pauses that can be multiple months, couple quarters, where the market goes sideways, and that's again keeping matching the color coding matching here. That's just a short-term pause in that long-term fundamentally driven uptrend. It's not until you begin to get these larger distribution periods where the flows become more balanced, inflows and outflows, as the market beneath the surface, one stock at a time, is beginning to adjust for what it sees as an impending deterioration in economics. And in this case here, we now know with hindsight, although some would argue, and I've argued in notes that I've written in the past, that the market was screaming that whole crypto digital space was a catastrophe and about to implode, whether it was stadium naming rights or celebrity endorsements or whatever you want to point to. I mean, all these things, while all these things were topping, this is what it looked like at the index level with the S&P. And so we had this sort of flows neutrality where the market began to adjust and adapt for this impending deterioration in market environment. And then, of course, it all rolled over with all three of these things moving together. And this red circle demonstrates that even during a bear market, you can get these sentiment-driven rallies. And if you recall back in that June to August rally, which I have highlighted here, was so strong that it drove the short-term model, this is our risk gauge, drove it all the way up into risk on. And the reason we didn't fall for that trap is because our long-term and medium-term models, which again are driven by actual fundamentals and flows surrounding those fundamentals, didn't budge from bearish readings. So that to us was a bear market rally, and layer on your shorts again, or maybe sell some of your longs or whatever. But it was not the beginning of a bull market, and that's what our process has done a great job of identifying all the way back to the 1960s. And this was an example of a potential head fake that just didn't register in our modeling process. And I think that's important to point out as it relates to what's happening today, as we'll show you. But of course, we know in time, we've kind of went into this balanced flows period where we had matching inflows and outflows as the market was beginning to adjust to the impending improvement in the economic cycle. And ultimately, what we see is that these three things are now appear to be moving higher again in tandem with one another, and this looks like a bull market. And that's what one could easily conclude by looking at the S&P. Right, the correction that we're having right now is just a short-term correction in the context of that ongoing, fundamentally driven, flows-driven bull market. That's what one could conclude by looking at this. But when you look at the risk gauge and you understand that long-term trend is actually driven by fundamentals, and remember, the risk gauge is measuring every stock, 2,600 stocks across the US market, one stock at a time on the quarterly time frame. So these are the trends that are driven by fundamentals. This is not what we're seeing beneath the surface. This is a major disconnect. And so I think this is the highlight of the current market trends that people really need to process. This market is not disengaged with the macro catastrophe that's taking place. It's fully engaged with it, as you can see here. If we look at the same exact market, only equally weighted, which is the value line geometric average, just what we want to point out is that most of the time, particularly during bull markets and bear markets, like when they're trending, both of those segments are trending, these two things move together. The value line geometric average was perfectly aligned with what was happening in the S&P 500 during the COVID rally. And during that period of time where there was sort of like this neutrality between flows, the same thing happened with the average stock. And then as the bear market got going, same thing happened. So the point is that it's this disconnect that we're seeing right now is not the norm. The norm is for these two things to move in the same direction when both of them, when one of them is moving a lot, the other one tends to be moving in the same direction a lot as well. And so this is the disconnect that we're seeing. So when people are saying the S&P is up 12% or whatever it is year to date, it's whistling past the graveyard of this macro environment that we're in. Here's a few facts for you to consider about what's actually happening beneath the surface in these long-term fundamentally driven trends. The XVG, which is the value line geometric average, is still down over 20% from this peak. That's a bear market. It's an unrecovered bear market. It's been in a range for over 18 months. There is no bull market here, not even a cyclical bull market. Most stocks are at or below their banking crisis lows. And the average bank is actually below its banking crisis low. So the epicenter of that crisis has not yet recovered. Most stocks are actually below that low. When you look back over the past year, when we think about the S&P being up 12% or whatever it is, hence whistling past the graveyard, the average stock is unchanged. There is no bull market going on beneath the surface here in this long-term trend. And then lastly, if you really want to process what's going on and how much the market is not whistling past this graveyard of macro death, if you will, the average stock is basically unchanged over the past 3 years. So this market is not at all disengaged with the bearish macro environment. So how this equally weighted index translates into our modeling process. Remember the risk gauge, which I showed you on the prior slide, that's got 5 components. It's got trend, price trend, relative trend, momentum, volatility, and breadth. Those are the only 5 things I care about, because those 5 things behave the same exact way in every single cycle. Whereas fundamental trends and sentiment, all these other things, valuation, they can all be different from cycle to cycle, but these 5 things have a tendency to behave the same exact way. And that's the value of looking at these 5 things. And remember, the long-term trend is driven by fundamentals. If there are good fundamentals, trends will go up. Eventually, they will reflect those strong fundamentals. And what I want to point out to you is that right now, the 3 time frames, remember, fundamentals, flows, and feelings, all 3 of them are showing the majority of trends in a downtrend. So if you look over here, 42% of the market is in a long-term primary downtrend. 44% is in a medium term. Again, remember, this is the quarterly chart, which is by anybody's measure is a long-term chart. This 44% is in an uptrend. That's the monthly chart. So by most measures, most technicians would say that's the long-term chart. This is my intermediate term chart. Only 20% of the weekly charts are in an uptrend. And again, most technicians would call that a long-term chart. I'm referring to it as my short-term chart. And in terms of what percentage of the market's experiencing positive momentum, despite what the S&P is telling you, it's a dearth of positive momentum. And when you look at the various bullish trends and bearish trends, we can put them into these buckets, which you'll see I repeat throughout my notes throughout the week. There's basically 6 kinds of buckets that you can be in. And then you can say, well, which one's the biggest bucket? As it stands right now, the biggest bucket, 29% of the market on the quarterly fundamentally driven trend, is in a trend that looks like this. That is not what the S&P is telling you, but this is what's happening beneath the surface. So it's clearly far more negative than what the S&P would try to get you to embrace. Now, the good news is, if I were to try to spin this positively, and I have been covering this in my notes, and I think it's a valid bullish point, and it is reflected in this disconnect between the S&P and what the average stock is doing. But when you look at this same exact model measured across 3 time frames, it is true that 39% of the market cap of the market is in an uptrend. And then 41% of the intermediate term trends market cap is in a base. It happens to be a negative base, which could be a top, but nonetheless, it's still not a downtrend. It is true that 35% of the market cap is in a short term, which again is a weekly chart. It's in 35% of the market cap is in a clear downtrend. So it's still leaning towards bullish, but clearly deteriorating. But if you were to try to say, well, show me something bullish, I would say that this is probably one of the things you can point to. Okay, so looking at how this current bull market effort has transitioned in our modeling process, going back to the COVID lows, What we can see, just again, how bull markets transition to bear markets, you can see that taking place here. So as the market was continuing to sort of trudge along in that what appeared to be a strong bull market, here again is the S&P line, because as this bull market was going on, you can see that the percentage of stocks in a clear downtrend actually was going up quarter after quarter. So while this was hitting new highs, more and more stocks were actually looking like this. So that's not bearish in that moment. It's just telling you that the air is getting thin. The oxygen is thinning out. There's fewer and fewer stocks participating. It's not until you start to get a dearth of momentum on the quarterly chart, which likely means that the monthly charts are now trending down, which was the case at this point, that you now have to take measures to protect yourself and get short, et cetera. And so this modeling process did a great job of identifying the impending bear market. And it did a similarly great job of identifying the October bottom. So as the market went to new lows, you can see that there was an actual increase of 6% of stocks in an uptrend. So while this was happening, there were actually more stocks doing this. And you can see that a significant percentage, there was a 10% drop in the percentage of stocks that were actually doing this while the S&P was doing that. So there's this divergence in underlying structure. And then when the market finally kind of stabilized in here, you can see that we had a big jump into these long-term quarterly time frame bases, which I've been writing about all year long on the idea that because we've seen so much improvement on the monthly charts, which is why this quarterly time frame improved so much, pushing 56% of the market to show positive momentum on the quarterly time frame. This is why these three time frames interacting led me to cover my shorts in October and November and build the long exposure out. And up until the banking crisis, the portfolio was behaving quite well. It wasn't until the banking crisis actually hit when things really started to disconnect. It looks like the S&P it did. The S&P continued higher, but it looks like based on all the other bear market bottoms that we can measure back to the 1960s in this process, these numbers here should be showing the vast majority of stocks on the quarterly time frame to be in an uptrend. We never even got that. Throughout this whole period, the biggest bucket has always been, and you've heard me and seen me covering this in the weekly motor reports, that the biggest bucket is bases on the quarterly time frame, which to me was bullish, because it had this sort of latent potential of these bases eventually breaking out to the upside, which the momentum on the monthly charts suggested it would, which was what was the case all the way back to the 1960s. That's all fine, but during this pullback, we now have the largest bucket of trend on the quarterly fundamentally driven trend is now clear downtrend. It's now 29% of the market is a clear downtrend. And while all of this was going on, you can see that the percentage of stocks that actually look like that actually has been steadily going lower. So this is just, I'm not saying it's bearish. This is, as I said, this is the first time that we've actually had an instance where the process signaled that, okay, the monthly time frame tells us that the quarterly time frame will improve, and so therefore the lows are in every window of time where the market, with this process has identified those lows. It has proven to be the case. And I'm not at all saying that this process bought the lows or anything even remotely close to that, because it didn't. But what it did was never falsely identify a new bull market. This could be, if we roll over here into a bear market, this will be the first time that's happened. What I'm inclined to believe or think is that for reasons I'll show you in a moment, that this is just, the bull market is stalling, and it's not ready to take root yet, because you can see here that we still do have 29% of the market is a quarterly time frame base, and 25% of the market is a quarterly time frame base of an uptrend. So it's not all a catastrophe. There's still a lot of latent potential here. It's just not a bull market, and we know what bull markets look like. This is what they look like, and you can see easily here that this is not what we're seeing. So you need to be mindful of this, be more tactical. Unfortunately, as I said earlier, be more willing to buy weakness and sell strength, and be more mindful of the need to be tactical until we can get this lift off or escape velocity to return once again on the monthly time frame to restore the potential for that on the quarterly. So as we're of course lacking any form of positive trend structure across the market, therefore we need to pay attention to these overbought and oversold conditions. So we know, I've covered this in the past, but we've We've seen these lows were really important to me. They came out, as we know, and a lot of folks are calling this a head and shoulders top. Obviously it is. I don't know if that's important or not, but by the book, that's what we can measure. As we broke this trend line in here, we can see that we had this big gap on heavy volume. That's never a good thing, of course. It tends to offer resistance to future rallies, which it appears to be doing now. If this pattern does work down to its target, it's around 40.80 would be the downside target. That happens to coincide with this band of support that I can also identify using other methodologies right in the 40.50 to 4100 area. So as far as I am concerned, given all the things that I just showed you in terms of how the three time frames are all in a downtrend, despite what the S&P is telling you, I think as long as we're below this resistance band, 43.75 to 44.75, I don't want to give up on the possibility. I'm not saying it's going to happen, but on the possibility that the S&P is going to find its way down here before we finally stabilize and find a low enough level to find some stability to drive the market higher into 2024. So again, it's not that it's going to happen. It's just that the best time to place the bet that this is going to happen is when we're overbought. Conversely stated, when we're overbought, don't be placing the bet that the bull market is, here again and we're going to new highs, because the underlying structure of the market is patently against that observation. Most stocks are in a long-term fundamentally driven downtrend. And in that environment, overbought conditions are very risky. And this is today's price action. And you can see that we tried to overcome the 50-day average. We're trying to work our way into this resistance area. I don't think it's going to be an easy fight. And so you can imagine that as the market works its way into this resistance band, the temptation is going to be to become more and more bullish and bullishly positioned and take on more beta in the portfolio. And unless we can see an improvement from the bottom up, I just highly advise clients to just be patient up here. Don't be loading the boat as the market gets up to 4,400 and 4,460. Right now, as I'll show you, the average stock is oversold, so I'm still okay buying right now. But as the oversold condition on the average stock is worked off, and the S&P makes its way further into that 4,440, 4,460 area, that's when you really want to put your brakes on, and maybe as a hedge fund manager, layer on some more shorts. Okay, so the notion is that this right now is not a time to judge a book by its cover. So the S&P is telling you one thing, the average stock is telling you something different. And it's not that it's bearish, but it's definitely not bullish. So it's more neutral than anything. And so we need to be mindful of that. So while the S&P appears to be trending and it's now overbought into that resistance, the average stock is actually trendless and oversold. So for this reason, I think that the average stock can continue to rally here. I think we can get up into this resistance area. It's interesting to note that this resistance band is the rough equivalent of the resistance band the S&P is now testing, showing you the dichotomy in the conditions between the average stock and the S&P. The average stock is nowhere near the resistance area that the S&P is testing. So there's a lot going on beneath the surface. And again, it's not bullish, it's not bearish, it's more neutral than anything. But we know what a bull market looks like, and this is not it, right? So that's the key takeaway. So until we can identify that the conditions are aligned for a bull market, then you want to be just more mindful of oversold conditions and overbought conditions. When we can identify a bull market, you want to throw out the idea of selling into overbought, because that's the reason you get long in a bull market, is because you want it to get overbought. That's the only way you're going to make money, right? So right now, until we can identify those conditions, overbought matters, and I think we want to be paying close attention to that as time goes on. So while the S&P is saying that this book is a romance novel, the value line screams horror story, and I think that's something that we need to appreciate. The market is fully engaged with this negative macro environment, and I think we just need to be mindful of that and pay real close attention to these overbought conditions, because that's the riskiest time and place to get all excited and bulled up about the market when you are actually not in a bull market. So what do we do about positioning in a portfolio with this being the backdrop? If there is one thing that I can point to that keeps me from identifying this as being something bearish, it has to be the cyclical nature of the leadership. This is something I've been harping on literally for probably 9 or 10 months, because it's been like this for 9 or 10 months. And this is what's kept me from being bearish. In particular, when things were bullish, this is what kept me, really quite bullish. But the idea that the market's rolled over and we still have not given up leadership amongst these cyclical sectors, you can't ignore that. So if we think we can look at the market, we can see all these disconnects that I'm pointing to. These are all messages emanating from the market, but we can't ignore this message as well. If the market, in its infinite wisdom and its ability to weigh the future, which Benjamin Graham has identified as being one of the market's great skills, if it's looking to the future, and this is what it's presenting to us in terms of the appropriate leadership based on what it sees in the future, this is just not bearish. A couple months ago in the video, I talked about ET coming down and visiting the planet Earth for the first time, and if this is all he knew was that this is the market leadership and he knew nothing else, he would have no choice but to conclude that the US was in a robust economic environment. And I think that that's what the market's trying to tell us about perhaps 2024, and the fact that it's been able to withstand all these pressures, particularly on the macro front, on the one hand, reflect that macro environment, which is partly higher rates and how it's affecting bond proxies and things like that, while at the same time not lose its grip on cyclical leadership. It just is what it is. You can't lose sight of that. And so, what should you be long in this environment? Well, you should be long this, and you should buy it when it's oversold, and you should resist piling into it when it's overbought. And that's the best I can say. And then when you look at the industries within the sectors, I mean, again, this is something I've been covering for a while, but this is literally a who's who of bull market leadership. If the market was looking forward and saw something to be concerned about on the economic front, this is not what leadership would look like. So the idea is to remain tactical, buy oversold, sell overbought, including shorts if you can do that, reduce your leverage, all of which sounds kind of bearish, certainly not bullish, but in that same breath, own current cyclical leadership. And we'll find out what this all means in the future. Our job is not to judge what will be, it's to judge what is, and this is what is. So if you're looking for ideas that have broken out, that are trending in the quarterly time frame, that fundamentally time frame, as well as the monthly time frame. So we've got fundamentals and flows going for us here, but are not extended from where they broke out. This is a good list of charts to take a look at. And you'll note that most of these are cyclical. Not all of them. There's a couple down here that are, we got REITs and staples. I didn't make any effort to screen by sector or by industry leadership. These are just all strong stocks across the market. We're coming up on earnings season, so I included here how many days we are from the earnings release. So just be mindful of that. So this is one area to look for buy ideas. And then if you're more in the buy pullbacks mindset, which of course, obviously I'm endorsing, not surprisingly, given that most of the market is oversold, this list is bigger, right? So pullbacks, this is a watch list that I have. When you see that the weekly motor chart pack that I do, this is where these ideas come from. It's a combination of this pullback watch list and this momentum watch list. They're all uptrends. They're just in various stages of the uptrend. So these are still trending in that longer term time frame as well as the monthly time frame. They've just kind of lost their trend. So they're more in consolidations, but they're not in such deep consolidations that they've derailed their trends or their momentum profile. So these are still great buying opportunities here as far as I'm concerned. And given that the market is oversold, I think there's a great list of names to take a look at here across some pretty cyclical sectors and industries. And again, keep in mind the days to EPS. Okay, so key takeaway is don't judge this book by its cover. It's fully engaged with the macro horror show that is. In this window of time lacking trend, you need to remain tactical. So buy oversold and sell overbought. And for those that are tactically oriented and don't manage $50 billion, that's something that probably resonates with you, and you can be tactical like that. If you do manage large amounts of money and liquidity is a concern, all this means is don't buy the bulk of your positions when the market's overbought. Right now, as I said, the average stock is oversold. So this is a good time to accumulate names that are on that list I just showed you because they're oversold or they're not trending, they're not exploited, that kind of thing. So that's what I mean if you're a big money manager, in terms of being tactical. Nonetheless, despite all of this, we want to remain overweight cyclical sectors, including energy, tech, industrials, discretionary, and financials, but not banks. Remember what I said, banks, the average bank is below the lows of its bank crisis low. So there's a lot going on there, and it's hard to believe that that's taking place while at the same time, the top 5 sectors are cyclical in nature, but that, again, that is what it is. Our job is not to judge, but to do. And that's what I advocate we do here. So right now, it's still avoid the safety sectors. There's just no indication from what I can tell that the market's concerned or hunkering in for something more dire, which is exactly what happened last year. Leading into the bear market, utilities and staples were amongst the leadership. They are nowhere near the leadership. In fact, they're at the bottom. So it's likely that these bond proxy type safety sectors are suffering from the fact that they're considered bond proxies, and with interest rates going up, that's obviously going to be a problem for them. But nonetheless, the market is perfectly okay with moving away from there and moving into these cyclical sectors, despite the fact that most stocks are not trending. Yeah, we'll find out why later. So I wanted to leave you with this idea. We will see another bull market. There's no doubt in my mind. And I do believe that this process that I just showed you, that we've tracked all the way back to the 60s, will once again identify when the average stock is once again realigned with the S&P 500 in the cap weighted indices. And when we have that, we'll be risk on again. But as it stands today, we're neutral. So that means be tactical. And when we're oversold, this is when you want to be more aggressive on your buying programs. So that's what I've got for you this month. As always, it just seems like there's tons of information to convey. I hope this was helpful. If you need anything from me, or you need any clarification, or you have any questions, you have my email address here. So please, at any time, feel free to reach out to me. Thanks so much.